the Bank of England interest rate decision, the minutes. You'll get the quarterly inflation report, the QIR, and also the accompanying press conference. So going to hopefully talk to you about the BOE. Obviously it's a day before the event happens itself, which is midday tomorrow on Thursday, the 2nd of November. But I thought I would just look at this given the complexity of the way in which the information might come out tomorrow, and I want everyone to be up to speed of how to approach this event. So first of all, just having a look at the pound and where we trade at the moment, and obviously we've seen the pound sitting at 132.72, and I guess if we start looking on let's put it on a daily continuation, and we can see where we are in the grander scheme of things. This is we steadied at this 132.87 price level, and as you can see, that was the previous high that we had when we initially recovered post the period of 2 months after the hung parliament situation. It's when the inflationary situation started to really heat up, and we got around towards that 133 handle, which is where we are at the moment. So we're still well off the highs that were seen at the time Theresa May gave that Florence speech. That was when you had that two kind of back-to-back candles, a really big rally. This was, if you remember, mid-September, the last Bank of England rate decision, where the vote split was still 7-2, so those looking for a more hawkish 6-3, that didn't materialise. And so the pound originally dropped, given that more neutral vote split. And we're going to talk about that a lot more and what it means. But then underlying that were very hawkish minutes, and the pound accelerated to the upside. And then if you remember, it was the day after, on Friday of that week, when Gerten and Flager, one of the newest MPC members, who is known as being the most dovish on monetary policy in the Bank of England, said an incredibly hawkish comment that rates will need to rise in the near term. And that was when we pushed up and saw that, consequently, that high a few days later. Since then, though, obviously Theresa May, pretty lackluster performance, ongoing lack of progression in Brexit. It's all kind of going against the Prime Minister at this point, and since then we've come quite steeply off those original highs before finding some support. Again, technically down at around the 130.50 type level in the futures, which was that previous high that you can see on two occasions here back in Q2 and Q3 of this year. So that's kind of the setup of where we're at the moment, but today's decision is particularly important. Why? Because it's going to be the first time in over 10 years that the Bank of England are likely to hike interest rates. Now, this is obviously very important because if we look at the global central bank scene at the moment, we've had the Fed hike 2 times already, and they're on track to hike a 3rd time in December, and subsequent hikes thereafter into 2018. The ECB have started now their tapering, as we know, of their QE program to 30 billion starting next year. So for the Bank of England, there's been a slight difference though in terms of what's driving their decision making, and this is when it really, what I want to try and explain with these next couple of slides, is the rock and a hard place that the Bank of England finds themselves in. And the key reason why they do want to hike is because they feel it's a necessity due to inflationary conditions. If you'll remember, we had just this morning the UK market manufacturing PMI come out for the UK, and it was higher than expected, but interestingly price pressures continue to be prevalent, a prevalent theme. And as you can see here on the top chart, I've got UK inflation 3%. It's the highest UK inflation now since April of 2012. So you can see here on the longer axis at the bottom, this is where we are at the moment. We've obviously got above this 2.9% printed twice in May and August of this year. And it's the highest since going all the way back to this period here at the beginning of 2012. Core inflation, often seen as the more kind of cleaner read, Xing out those volatile components, is the highest since 2011. So certainly this depreciation of the pound and its eventual feed through has definitely come through almost some 14-15 months after the actual EU referendum itself occurred. Now what does this actually mean? Well, this is kind of I think this graph gives you a pretty good idea of how the land lies at the moment in the UK for the consumer. Now, if you actually look at the unemployment rate has been falling very steadily really since the peak that was seen in the aftermath of the financial crisis. This was kind of mid-2011 when we got above 8%, but since then it's been a fairly consistent pattern of an improving jobs situation, in fact to a level of which was seen pre-financial crisis itself. So the unemployment situation, the amount of people in jobs in Britain, actually remains fairly healthy. The more interesting path though here has been these two lines down at the bottom, and the lighter colour here is weekly earnings growth ex bonus, and this darker shade here that was around 0 and actually did go in deflationary territory very briefly through 2015, this then being this point around the lows, the EU referendum, now this really strong, obviously, trend we've seen of the re-emergence of inflation. Beginning of this year, at the end of Q1, that's when we saw these two lines cross. That meaning then that we're in negative real wage growth, which is obviously a very tricky situation for the Bank of England, because that means then for an average UK consumer, the costs of goods is far exceeding now the amount of which their wages are also increasing. And if you look at wage growth, if you average out post-financial crisis, it's roughly 2%. Pre-financial crisis, it was 4%. So people's wages are going up only half the amount that they were prior to the crisis. Irrespective of the fact that more people are getting employed, they're not getting paid more. And now, with that weakening of the pound, it's really accelerating prices, and the question is, do the Bank of England need to act now in order to mitigate this becoming an even worse situation? Now, what does it mean then when people aren't getting paid more? Well, people will save less. And I think this is a chart I've probably referred to a few times. This is the households responding to a squeeze in incomes on savings less. And actually, as you can see here, you've got to go back really to the 1960s when UK consumers were were saving from their monthly pay this small amount. And actually it equates to about 0.6% that an average UK citizen saves per month. So net households are getting squeezed. And what does that do for confidence? Well, ultimately that should lead to less confident consumer, which would then ultimately spend less. And so if that was the case, then is there the argument that actually prices in terms of demand should start to peter out anyway, given the lack of people wanting to spend because of a lack of money that they have, given the prices of just cost of living is going up? This is the situation as it's really evolved over the last this is kind of going back. This chart here is referencing the beginning of September to mid-September. Now, yes, this is slightly dated, but the percentage of how much is priced in is roughly the same, kind of 80 to 85%. Now, the bars at the bottom show the probability of a rate hike in November on each subsequent month, and you can see at the beginning of September that was about 20%. If you look at the white line, this is only 2 weeks after. This was at 80%. Now, why did the market reprice the probability of a hike so substantially? Well, it was these three top things that happened. September the 12th, UK CPI jumped to 2.9%, a core reading to highest since 2011. That September 14th was when you had that meeting, the last rate discussions and minutes where they said some withdrawal of monetary stimulus is likely to be appropriate over the coming months. Then you had Flager, the dove, say that interest rates could rise in the coming months, and we saw this steep repricing of the probability of a near-term hike. Since then, you've then had UK inflation go up even higher to 3%, just 0.1 away from Carney having to write a letter explaining his inability to reach his mandate of a 2% target to the Chancellor. And then, following on from that, just last week, you had UK Q3 GDP. The preliminary reading was a surprise because it came in higher than expected. So this argument that the economy should be slowing under the kind of tightening of belts from consumers and their spending, given we're a service-driven industry, didn't play out quite as much as people may have thought, and actually GDP was better. So we are, at this point, expecting an interest rate hike. Next question then is, how do you trade this event? Now what I've done here is I've broken this down into a sequence of how the information is going to come out tomorrow, and then also how I think then market movement will probably play out, and how market participants will have to digest and react to each part as it kind of presents itself. So part one, the immediate reaction in the pound tomorrow is going to be definitely hike or no hike. Now we're going to have a look in some slides in a second about the reason why some people, I for one, don't think that a hike is as assured as maybe as the percentage that the market is positioned for. Market pricing, as I say, has gone up to almost 90% a few days ago that they're going to hike. 90-10, do people remember what the last probability of a big UK event that was priced at 90-10? EU referendum. So, not to draw too many comparisons, but the market can get it wrong, is what I'm saying with how it's positioned. And looking at the interest rate, this is the interest rates in the aftermath, the collapse in rates that we saw back basically to near zero in the wake of the financial crisis. And we've stayed there, i.e. we've not had a rate hike. You've got to go all the way back off this chart to the left to 2007, the last time rates went up, so well over 10 years. Now, if you remember, the Bank of England did actually cut rates in the immediate aftermath of the referendum. I think this was August 2016, if I remember rightly, when this dip happened. They took rates from 0.5 to 0.25%. Now, the rate hike, in context then, is only taking back what's called the emergency cut, which was the Bank of England trying to be preemptive of the economic slowdown that would come after the referendum. But we know that actually the Bank of England was overly pessimistic with their assumptions at that point. So there is a credible argument that they could just do this one rate hike, and then that takes back the emergency cut that was seen last summer. That's the thinking for the hawks. The problem I have with that is the other side of the coin, if you're looking at it from a dovish perspective, is that what payback do you get from just a single hike? And also a rate hike trajectory tends to go in a sequence of rate hikes, like the Fed have done, initiating their first rate hike in December 2015, then 2016, followed by then 2 more this year and a third to come in December. You know, we're on course for the 5th rate hike in the cycle. This is quite typical of the way that central banks tend to stagger their rates back to a neutral level. Now, this is why I think that the Bank of England don't have that luxury. If they do hike, I do think it's just going to be one and done in that respect. So, market pricing, 85%. The first market reaction, like when you guys have traded non-farm payrolls or the oil inventory data, the first move is normally the headline. And then once the market digests the underlying numbers, then the volatility happens and an overall trend normally materializes. What I'm saying is that the first reaction will be hike or no hike. Given the fact the market's positioned for the hike, if they don't pull the trigger, there's going to be a very, very big move initially to the downside in the sterling currency. Next step from there is going to be the vote count. And you have to apologise for the crudeness of my PowerPoint skills, but I've just put this together this afternoon for the purpose of this conversation. The count is really important because there is definitely a scaling impact of how the pound will react depending on the split of the votes. 9-0 being unanimous to hike, and 5-4 being just over the balance, tipping it by 1 vote to hike. So this is kind of the least hawkish, and then we scale that up, 6-3, 7-2, 8-1, 9-0. And how far the pound will rally if they do hike will be dependent on the vote composition. Obviously 9-0 is going to be a much bigger move to the upside than it would have 5-4. What you might get on 5-4 actually is a pop and then it might start to come down again because it was such a close call, and then we move to the next part, which is the next slide in minutes. If I was looking at probability of how the vote split might come out, I would say a 9-0 unanimous MPC voting for a 25 basis point rate hike, I think, is the most least likely of what could happen. I actually think the most likely is it's a very close call. We're going to have a look at what some of the MPC members have said lately, but the way that Cunliffe has been speaking, the two new members, Ramsden and Torreiro, they really don't sound particularly like they want to be hiking rates right now. What they have said is that in the coming months. So this is an interesting topic. So the vote split will then be important. So hike, no hike, then the count. And the most likely, I'd say, is probably scaling down towards being a very close call. The next point then is the minutes, because with every Bank of England decision you get the minutes. This one is going to be no different. And what I thought I'd do is I put a table here that I managed to get off Natexis, and this basically puts together all of the comments from all MPC members, the most recent comments. And if you actually look, only Ian McCafferty and Michael Saunders to this point have voted for the rate hike. If you remember, there was Christine Forbes. She did, but then she left and she's been replaced since. So these two are kind of mainstay hawks. The question is, who's going to join them? Now, Andy Haldane was the one that in September people were suggesting could have joined and become the third of the 6-3 split. However, that did not materialise. But given his recent comments, I'd say he has a potential definitely to switch at this point. The ones that I'm looking at though, and the ones that makes me a little bit, that I believe that there's a real credible chance they may hold, is because David Ramsden has sounded very dovish. He said, I voted to maintain the bank rate at 0.25%. A majority saw a case for removing some monetary policy stimulus in the coming months. I was not part of that majority. So he was saying, I did not want to say that. So that's incredibly dovish in my mind. And he's one of the newer members. Silvana Tenreiro expressed that she was slightly more open to a rate hike than Governor Carney, so it's kind of on the balance, but her other comments have been dovish. Flager is that kind of dove-turned hawk. It's going to see interesting whether or not he's willing to back that, though, with an actual vote. Then you've got Cunliffe, who's been particularly dovish of late. He said, we do not have to look at what's happening to domestic inflation pressure, and I think that on the data we have at the moment, it gives us a bit of time to see how this evolves. So basically he's saying, I don't think we need to do anything now, we should just wait and see. So that's being dovish as well. Ben Broadbent, he is kind of in the neutral spot as really as Mark Carney. So as you can see here, when you start breaking down the recent comments and communication we've heard, I definitely think it's going to be incredibly close. The key areas of the minutes that I'd be particularly focused on are the level of discussion on the future path of inflation, i.e. where is the peak, and this is going to lead us into the QIR report, and what assessments they make about growth potential. You know, if you think about it, there is still this very big looming issue, the elephant in the room, Brexit, and clarity over a transitional Brexit deal. And it remains very material to the MPC's outlook. If no transitional agreement is reached by early next year, then what you can expect is a pretty big shock on the demand side as the economy starts to wind down under the cloud of uncertainty and political weight becomes more of a pressure. And that's only going to make this ongoing situation outside of inflation all the more worse for the UK economy. So definitely that's going to be important to look at in the minutes. The next part, and this is when we've got the rotation of the every other meeting. So the last time we had this would have been the August quarterly inflation report. So now we're in November. This will be the latest updates as to what these are called the fan charts. These are the Bank of England's projections for CPI and GDP. And what we're looking out for here is there any meaningful kind of recalculation of the Bank of England's forecasts of where they see inflation over a 2-year horizon? I would say that given inflationary conditions have been more elevated now since they were in August, I don't think it would be that surprising to see them just bump up the inflation forecast a little bit. What will be interesting is to see how confident they can be about growth, particularly with this uncertainty on Brexit. So the quarterly inflation report forecast will also be telling. Then you've got this chap, this being Mark Carney. Of course, he'll deliver a statement and then he'll have a Q&A. The first questions of the Q&A are normally the most important, and that session will normally last for anything up to about 45 minutes. Now, the press conference, this is another reason why those believe that the Bank of England may well act tomorrow, and that is because, like Janet Yellen and the Fed, these central banks like to change policy when they have a meeting, when they can accompany it with a press conference, and they can be transparent, communicate to the market, take questions, and mitigate any market volatility that may have occurred from the initial release. If they don't hike rates now, the likelihood is that a rate hike has been pushed off the table until February, which is when the next quarterly inflation report comes out. Not only that, but if you think to February, you should then, at that point, have the transitional deal, or a lot more clarity on that, if not secured at that point, because the timeline on that is more geared around the end of the year to get that job done on the divorce bill with Europe. So, in summary, in terms of a sequence of execution, I break down tomorrow's event into 5 distinct chronological events. And this will be how I suggest that you need to look at the market in terms of how to trade it in the way in which the pound will react in what order. First of all, it will be hike or no hike. That's the most knee-jerk reaction. Then it's going to be the vote split. How hawkish is the composition if they do hike? Even if they hold, how close were they to hiking? This could also be very important. Let's say they don't hike, the pound drops very sharply. If it was a 5-4 to hold, i.e. the most hawkish without hiking the Bank of England become in over 10 years, then you might actually start bouncing off that initial knee-jerk lower. The tone of the minutes, how worried are they about inflation? How confident are they of, let's say, if they hike, that that's going to be the job? Or are they less certain about the future prospects for the UK economy given the cloud of political uncertainty? Then the projections from the QIR will come out, and we're going to have to look at how does this fit with their long-term forecasting of inflation. And then the press conference, which will come afterwards, half an hour after the first 4 points. And at that point, obviously it's going to be, if the market is, let's say, reacted very hawkishly, if that were the case, I'd expect Carney to sound quite dovish in order to balance the market out and not get it too carried away with sterling appreciation. And if it was on the opposite, if the Bank of England don't hike tomorrow, I can assure you the tone of the minutes and the press conference will be extremely hawkish, because the market will revalue itself quite sharply lower in an unwind of this high pricing, and then he will want to credibly say, we will definitely take action if this persists. So credibility is utterly key. A lot of people have obviously said that given the market pricing of nearly 85% or so, if he doesn't pull the trigger, he's going to lose credibility. I actually think that he could still maintain it if he has the right communication post the event itself in the press conference. So that's pretty much it. Then one tip here I've put at the bottom, if you want to watch the press conference live, you can obviously access that on the Bank of England website and YouTube, but actually what I found is Periscope has been the fastest to receive information for these type of live press conferences. Aside from the Bank of England, one of the other things is, don't forget that tomorrow is not just this Bank of England event. Tomorrow is a really important day, because tomorrow, of course, is the announcement of the Fed chair. So I'm not going to go into that too much here now. I'll talk about that tomorrow. But Donald Trump has just tweeted a short while ago saying that he's going to announce the Fed chair tomorrow. My thinking on this, there is no set timing. is that Trump already has been trying to drum up interest, saying that he's really excited and he can't wait to announce who the Fed chair is going to be. I would say you'll get more of that tomorrow. Then he'll probably hold a press conference to deliver who it's going to be, whether it's going to be Powell, Taylor, possibly Walsh, or even Yellen. I put nothing past Donald Trump at this point. And then also to look out for any updates on the tax reform issue as well. So really busy day tomorrow. I suggest you get a good night's sleep, and good luck for tomorrow if I don't speak to you before then. Otherwise, have a good evening. Thank you very much.